Hello, everybody, and welcome to the Dorsey Wright Podcast. I'm Ian Saunders.
And I'm Eric McCardle.
And it is Wednesday, September 18th, and the markets are down slightly here this morning. We started off in a similar fashion there yesterday morning and ended up just up slightly for the day. So relatively unchanged there yesterday and shaping up to be a similar kind of lack of movement, at least so far here this morning. But even though we haven't seen quite as much movement from at least the prices of the major indexes there, we have seen a couple changes to some of the major indicators that we follow here on the platform. Specifically, if you recall, over the past several weeks, we've seen most of the major bullish percents that we track here on the platform, such as the BP NYSE, the bullish percent there for the New York Stock Exchange, as well as the BP SPX, the bullish percent for the S&P 500 index. Those have reversed back up into X's. And actually, yesterday, we saw the final kind of major bullish percent indicator, the bullish percent for the NASDAQ OTC over the counter markets, ticker is BP. OTC, that finally reversed back up into X's at 40%. It had been creeping quite close, had gotten within 1% with trading there on Monday, and finally reversed back up from a level of 34 up to 40% there yesterday. And now that actually rounds out all of the major bullish percent indicators that we have on the technical indicator report have all now reversed back up into X's. And so what does that mean? So that's initially just from a straight definition standpoint, telling us that there is a obvious demand kind of returning to the market, and that more securities in all of the kind of major indicators are participating in that upwards movement, and with that increased demand there. It makes sense that the BP OTC would reverse slower than let's say the BP NYSE, given that it has more members in that basket that it's looking at. So the New York Stock Exchange has about 2,000 members that we track here on the platform, whereas the NASDAQ OTC market has almost 3,500. So with those 1,500 more members, it's going to take that indicator longer to see more of those securities from a percentage standpoint return to buy signals to cause that indicator to move higher. You can see, looking at just a straight chart comparison of those two indicators, the BP OTC moves around quite a bit less than the BP NYSE, although they're both going to be looking at an intermediate term picture there. So definitely a positive sign that we're seeing the BP OTC reverse back up, and X is there, placing it in that bear correction territory. When we're looking at some other indicators there on the platform, obviously we have a lot of indicators on the technical indicators reports page. There are a few that we're still monitoring for that kind of further follow through to the upside, specifically looking at those positive trend indicators. So the bullish percent indicators measure the percentage of securities in your given basket that are on a current point and figure buy signal. The PT charts, positive trend indicators, measure the percentage of securities in each respective basket that are trading above their bullish support lines in that longer term positive trend. And so it would make sense as well to see the bullish percent charts reverse higher. Stocks would move to a buy signal before you see those stocks return to positive trends. But a few of those PT charts are within a percent of reversing back up into X's as well, actually. Specifically, they're looking at the PT NYSE positive trend for the New York Stock Exchange is actually within 0.5% of reversing back up into X's. The reading yesterday was at 47.67. It needs to get to 48 to reverse back up into X's. And also the PT World is now within 1% as well. It needs to get to 38. Current reading yesterday was at 37.19. So when you're looking for some kind of continued follow through to the upside with some of these positive developments we've had, those are two places that you can look towards there. The PT NYSE for that 48 threshold, and then looking on a more global scale, that PT World as well at 38.
Yeah, and these are all great developments, and I want to put an exclamation mark on what you said about seeing follow through to the upside, right? So we've seen the BPs reverse up into X's across the board. We're starting to see the potential for the PTs to reverse up, and so what does that mean for you in terms of your posture right now? Obviously, being in X's on the BPs is a good sign. It means you are offensive in your position. This is an opportunity now for you to come back and assess the playing field on a little bit more of a granular level. And what I mean by that is, looking at specific areas within domestic equities and identifying opportunities for long exposure. And one of the best ways to do that on the Dorsey Wright platform is by viewing the asset class group score page. And this is found under asset allocation at the top of the page, and then by clicking asset class group scores. And when we get to this page, what we're going to do is check sectors in our filter view and then hit set view. And what this does will then refine our results to domestic equity sectors as well as some of the major macro groups around the world, so we have some market context. And one thing that you're going to do when you come to this page is you'll be defaulted to ranking by average fund score. As a reminder, the fund score looks at trend and momentum characteristics as well as relative strength versus the market and relative strength versus the fund's peer group. So it's pretty comprehensive reading. 0 is the worst, a 6 is the best. And so on the onset, when you come to this page, everything is ranked by score. So you see your 4 or better labeled as blue, right? So these are typically your optimal areas for long exposure. Now, when you look below in the green section, you'll have 3 to 4, and these are considered acceptable, right? So you could have long exposure in this area of the market without really worrying too much. But as is always the case, you want to stack the deck in your favor as much as possible. And one of the best ways to do that is by sorting by fund score direction. You can do that by simply clicking the directional column at the top of the asset class group score rankings. And this is going to give you a look back on how those groups have either improved from a fund score perspective or have lost fund score points over the last 6 months. Now, 6 months can also be a long period of time, right? We just went through a volatile August. We've had trade concerns bounce back and forth really for about as long as I can remember. Mm-hmm. So maybe 12 to 18 months. And so I think a lot can change in that period, and it's helpful to be able to maybe take out the magnifying glass and look a little bit more on a granular scale. So the way we can do that is if we go to the top left of the asset class group score page, and we simply click Group Score Report. And again, we're viewing our sector group, so we're going to have that filtered there, and that will pass through to Group Score Action. But this allows us to manipulate the look back period. So it defaults to looking back 30 days rather than 6 months or 180 days. And what we can see here is recent improvement among some of those groups that we've identified as acceptable, 3 or better, or optimal, 4 or better. And we look at the 30-day movement for starting with transportation. It's a 3.4 average, up 0.5 or 50 basis points on that fund score over the last 30 days. So this is an area that is seeing improvement, looking better for long exposure. Additionally, we see industrials with a 4.26 average and an improvement of 0.5 as well. So that's an optimal group that is improving, meaning it's trending higher from a fund score perspective. So there's a number of different areas in the domestic equity space that you can look to asset class group scores and really refine your potential long exposure. So we encourage you to do that. We'll put an image in to the podcast video as well to show you some of those groups. One thing I do want to bring up, Ian, when you mentioned the market's been relatively flat today, waiting for Fed announcements to see whether there's going to be an additional rate cut. One stock that we saw break down on the open in response to some negative news was FedEx, right? Mm-hmm. And so this is typically viewed as a stock that is going to be somewhat of a barometer for the global economy. So when you see a big announcement for FedEx or a UPS, that's typically something to pay attention to. And we saw FedEx reverse down into O's today, return to a sell signal at 152, and also with that return to a sell signal also violate its bullish support line. So it's going to be moving back to a 0 for 5er. Mm-hmm. And that does fall in the transportation group, so I know I pointed that out as one of the best improving areas of the market. But I think having that additional nuanced context and maybe taking a step back, seeing how transportation pans out over the next few days would be prudent. So just want to bring that up to you all. It was something we found this morning that we thought was interesting.
Absolutely, and I especially think you mentioned there before that with the asset class group scores page showing that more granular movement. One of the other developments that we've seen here recently on the platform as well is some of the recent outperformance of the commodities space. A few different names in there that we're looking at, but if you look at the asset class group scores page and you look at, instead of that individual sector view, you can go ahead and look at all the groups there, all 135 different groups that we track. Commodities has spent most of the time over the past year plus down in the bottom end of those rankings, down pretty close to where money market is, actually, the cash there. But if you notice here recently, actually, with some of the near-term improvement in gold and crude oil, the commodities group there has actually risen above money market from a fund score perspective. And if you graph those two scores together there, you can actually see that's the first time that's happened since October 31st of last year. So even though we've seen cash drop significantly there in the group scores, commodities has been spending most of its time beneath cash, even though cash was such a low percentile rank right now. That just jump upwards there earlier this week is the first time that commodities has had a better average score than money market since the end of October of last year. So what areas are we looking at within commodities that might have caused some of this recent improvement? Well, I'm sure that you've seen in the headlines there, we've seen quite a bit of, there was a pretty substantial rally earlier this week in crude oil. So we saw crude oil rally from kind of levels around in the mid 50s up, reaching all the way up to 63 on the continuous chart in our platform, that ticker CL/. So an intraday reading of up at 63, moving the security had moved back into a positive trend earlier this month. It's on 2 consecutive buy signals there from the continuous futures contract. Although we have seen it pull back a little bit here recently into the upper 50s, but a significant rally that we're seeing there, and definitely something to take note of. Noticing as well from an equity sector perspective that a lot of those oil stocks, those oil-based, whether they're drillers or those oil services stocks, are doing a little bit better here recently as well. We saw the oil group reverse up from a bullish perspective on equity sector basis. So definitely a place to take a look out there in the commodity space, as well as how that follows through to the equity space. And then another commodity that we've been tracking quite a bit here over the past several weeks has been gold. That ticker on our platform is going to be GC/. And so we saw that stock rally to multi-year highs up at 1560 earlier this month, and then reversed down and give a quick sell signal at 1520, moved lower there to right about 1500, reversed back up into X's and looked like what we thought would be a shakeout pattern. So for those of you who might not be as well versed in the point and figure charting patterns, the shakeout pattern is going to be anytime a security is in a strong uptrend, typically going to be multiple consecutive buy signals. It forms a double top and then reverses down to give a quick sell signal. And the idea behind that is that that initial sell signal, first sell signal in a strong uptrend, is going to shake out those that are bearish on the security, and then your buy point would be on the subsequent reversal back up, hoping that the security would then continue to give a triple top break above that double top there. And so we saw gold reverse back up into a column of X's, and then pretty quickly within a day or two actually reverse back down. So that would negate that shakeout pattern. Although from a longer term perspective, gold's still in that strong positive trend and has given one sell signal, has not moved to that second sell signal yet. That would not come until 1490. But another point to watch out for, we've seen the improvement in gold follow through to some other areas in the commodity space, specifically in the precious metal space. Looking at the chart of silver, we don't talk about silver quite as much as we do about gold. It's not going to be in the headlines quite as much, but we saw a very, very long-term negative trend that silver had broken through right at the end of August there. So that trend was going back to 2012 that silver had been in that negative trend there. It broke back through the silver continuous chart, SI/, broke back through to a positive trend right there in August at 18, rose to a multi-year high at 1950, similar fashion, multi-year high like we had seen there in gold. And then given the some of the recent pullback in gold. The chart of silver has pulled back a little bit as well, down to 1750 on that continuous basis there. So another point to look out for, although you see gold in the headlines quite a bit more than really just about any other precious metals, there are others out there, and definitely some other places that might be pertinent to take a look at there as well.
Absolutely, Ian. And when you mentioned, the potential for, say, a shakeout pattern or, some notable chart pattern from a point and figure standpoint, one of the benefits to the system is that you actually have the ability to find positions, whether they're stocks, ETFs, commodities, indices, that have recently completed patterns or have the potential to do so. And that can be found under security selection, security screener, and then pattern report. So we encourage you to take a look at that, and that way you can find these ideas before we bring them to you. But I think that's an important aspect of the site to be aware of.
Absolutely. Some other important aspects that we were taking a look at, or at least we're talking about here, Eric. We have some new models that we've come out with here on the platform that we'll be actually highlighting in an upcoming webinar here. But before we talk about that, there are a few points that you wanted to mention there, specifically looking at one of the new stock models we have, the blue chip growth model. Is that right? Yeah,
that's right. And we spent some time early in the podcast discussing offense being on the field, looking at different sector opportunities for potential long exposure. But if you're familiar with the Dorsey Wright platform, you'll know that our models will often provide a solution and take the decision-making process away from you. It just removes one variable. They're all rules-based and easy to follow. So on that point, when we look in the large cap domestic equity space, this new model, our blue chip growth model, is a great solution. It holds 5 stocks from within the top 30 mega cap names in the domestic equity market and uses an RS matrix to reassess the inventory periodically. So a really great solution for clients. Right now, it's got a number of quality holdings, as the name would suggest, including names like Microsoft, Home Depot, Cisco, right? So really good blue chip names. When we look over the last year, the model is up 6.62%, which is outpacing the S&P 500, which returned 4%. So, strong from a long-term, a one-year performance standpoint, as well as if you look back on the info file, which is found on the models page, you can see performance, prior to that period as well. And one of the nice things, additionally with this model is because you're holding these large cap names that are oftentimes dividend payers, the model itself has a yield of 1.6%. So fairly attractive from an income perspective as well in the domestic equity space.
Absolutely. And looking at with that model in particular there, it's going to be one of those matrix-based models, as you mentioned. We actually next week have an upcoming webinar that is going to be focusing on how to use the matrix tool to make sure you have a solid basis on the concept of relative strength, and then reviewing some of the stock models that we have on the platform, specifically highlighting the newer stock models we have, that blue chip growth model, as well as the IndieX model, which came out earlier this year. So that webinar is going to take place next Thursday. That would be next Thursday, September 26th at 1 p.m. Eastern Time. So if you're interested in signing up, if you're interested in learning more about either the blue chip growth model, the IndieX model, or just the general matrix tool as a whole, please do go ahead, sign up for that webinar again next Thursday, September 26th at 1 p.m. You can register there in the Were You Aware from yesterday. Another event that we have coming up is going to take place in a few more weeks from now is the Fall 2019 Point and Figure Institute that is going to be held here in Richmond, Virginia. That is going to be one of 2 Point and Figure Institutes that we put on a year. One we do in Vegas in the spring, and then this one here in Richmond every November. It's going to be the second week in November there, that Wednesday, Thursday, and Friday. So it is a 2.5-day session really there. Strongly would recommend to take a look at it. If you're looking to come, the Wednesday half-day session is an optional session, but it is going to be focused more on the kind of basics, the concepts of point figure analysis and relative strength that are going to be very pertinent for the remaining 2 days. So definitely want to make sure you take a look at that to make sure you have a solid basis for the remaining 2 days if you are looking at signing up. Sign up information for that is also available there in the Were You Aware section of the Daily Equity Report from yesterday.
Yeah, and if you are listening to this or viewing this from outside of the subscriber base and you have any questions regarding the webinar that Ian mentioned or the upcoming event, such as the Fall Point and Figure Institute, feel free to shoot us an email at dwa@dorseywright.com or give us a call at 804-320-8511. And we'd be happy to help you with it.
Absolutely.
So with that, I think that's about what we wanted to cover today. We'll see you all next week.